So, you are looking at purchasing a new home. That's great. Home ownership can feel a bit overwhelming at times, with the difference in mortgages that are out there to understanding the factors that impact your eligibility for obtaining a mortgage. Throughout this short presentation, we are going to dive into some of those factors, as well as give a general overview of some of the popular types of mortgages that are out there. When deciding that you want to purchase a home, there are a few factors you'll want to consider, from the type of home, which can often dictate the price of the new home, to knowing what your budget is, as well as what your cash reserves and credit profile look like. Cash reserves would be the funds that you have available to you in case of an emergency or preparing for doing repairs to the new home, as well as even what you would have for down payments as well. You'll want to determine the amount of house that you can afford as well. So according to NerdWallet, they'll want you to utilize the 28% to 36% rule to determine that. This rule states that you should spend no more than 28% of your gross monthly income on home-related costs and no more than 36% on total debts, which includes the mortgage and other loans or credit lines. The best way to calculate that is by taking your total income and multiplying it by 36%. Then subtract the total debts that you have currently from that amount, and that's the amount of mortgage payment you can afford. Now that you have that, let's take a look at an overview of some of the different types of mortgages. The most popular types of mortgages are conforming conventional, fixed rate, adjustable rate, and non-conforming loans, which includes FHA, USDA, VA, and jumbo loans. Let's start by breaking down the difference between a conforming and a non-conforming mortgage. A conforming mortgage that is conventional is considered to meet the requirements set by the government so that it can be sold to companies like Fannie Mae or Freddie Mac. There are specific requirements for this type of loan, ranging from a credit score needed of at least 620 to making sure that the house does not exceed certain purchase amounts based on the area you live in. As a result, these loans can sometimes be less accessible for those with lower incomes or higher debt-to-income ratios. But if you are able to obtain one, they can often cost less and even come with some protections due to the federal backing. In comparison, the non-conforming loans do not meet the guidelines for the federal government has set, which means they cannot be sold to Fannie Mae or Freddie Mac. The factors that can impact eligibility is that you may need a larger loan size than the conforming allows for, or your credit score may be at a 630 or less for certain types of non-conforming loans. Overall, non-conforming loans provide more options and accessibility to borrowers, but they often cost more due to the risk the lender has in offering the loan, and thus the cost of the risk is passed on to the consumer. The four types of non-conforming loans we choose to focus on are the FHA, USDA, VA, and jumbo loans. With the FHA, this can be a good if your credit score is only at a 500 or above. It does require you to have a down payment of at least 3.5%, and eligibility can depend on your debt to income ratio. USDA loans require at least a 640 plus credit score, but do not require a down payment. However, they look for the household income to be below 115% of the area average. VA loans are specifically available to active duty service members, reservists, veterans, and surviving spouses of those who passed away as a result of injury or death from service. They do not require a down payment or minimum credit score. Lastly, let's look at jumbo loans. A jumbo loan is one that has exceeded the price cap of the conventional loans set by the Federal Housing Finance Agency. They can have fixed or adjustable interest rates similar to other non-conforming loans and conforming loans. As their name implies, they are for a large amount and the loans are not protected if the borrower defaults, making them a high risk for the lender. As a result, it requires factors like a 700 plus credit score, 45% or less debt to income ratio, and often can also require more documentation to verify that the borrower is able to pay back that loan. Now that we have covered the different types of mortgages, let's look at the different types of rates that can impact them. A fixed rate mortgage means that the interest rate will not change for the life of the loan. This is where you typically see repayment periods of 10, 20, 30, 15 years. As the loan reaches its full maturity, the payments start to go more towards the principal versus paying the interest. The benefit of a fixed rate is that the interest is not impacted by market changes. However, it can be challenging to qualify for these types of loans. In comparison, the adjustable rate mortgages can fluctuate, which means that your monthly payments could also fluctuate. For adjustable rate mortgages, the introductory rate can last for a certain length of time. This is often given in years ranging from 3, 5, 7, and even 10 years. The benefit of an adjustable rate mortgage is that it can have a lower interest rate to start, which gives you a greater chance to pay more towards the principal balance. But the rates can fluctuate up after that, causing your payments to rise, and it can also potentially have prepayment penalties as well. I hope that this presentation has been helpful. Remember when purchasing a home to know your budget, know your credit score, and make sure to use the 28-36% rule to determine what you can afford for that budget. And ultimately, use those factors to determine what loan is right for you.